So basically at this level, all they want you to know about ratio is what you have on that material. And there are two things involved. One thing is to know how to calculate the ratio. Another thing is to interpret. Even when I was writing my FRs here, FR, they calculated the ratios for us. They now say interpret 15 marks. Yes, they've done all the ratios for you. They said they are based on the ratios calculated above. Advise the management on so. So it's not time for you to write grammar. So that's the two arms you must know, make sure you cover. One, know how to calculate the ratios, and most importantly, make sure you know how to explain the ratios. And by doing so, you are good to go. Okay, so let's look at it this way. We have what we call profitability ratio. That's one part. We have what we call efficiency ratio. We have liquidity ratio. That is what they use to test most. That three. Profitability, efficiency, and liquidity. Then the other one they can now test is when they are talking about the debts, gearing ratios. It can be also the testing other one. Any per share, all these things you just finished now. They can also test them. You know, all this any per share you just finished also look like ratio. So they can as well test that area. But these are the main aspects of it. So all these ratios now divided into different categories. So when you're talking about the profitability, let's start from profitability. I just want to use 1.5 hours for this. I will use the remaining 30 minutes on cash flow on the same question we have. So you just go and practice it. It's very similar to, it's even more lower than what you have done. Eh? No. No, it's not Pascal. It's in past question. It's in this past question we are going to treat. It's the same year. They tested that cash flow as question 1. They tested this ratio as well. So the cash flow in that past question is very low to what we have done as first question. So I'll just explain brief things within 30 minutes. We not even. No, the answer is already in the past now. Oh, I'm sorry. Okay, so under this profitability ratio now, we can calculate gross profit margin. We can calculate gross profit margin. We can also calculate. We can calculate PBIT margin. We can calculate net profit margin. We can calculate ROCE, that is return on capital employed.
So it's under profitability ratio.
Yes. We can calculate return on equity. We can calculate return on assets. So we can calculate all these ratios. We can as well calculate growth in revenue. So the growth in revenue is talking about like trend analysis. So these are the formula, these are the ratios you can calculate under profitability ratios. I believe online can hear me. So let's now take it one by one now. To calculate gross profits from the word alone, you will derive the formula. Are you getting it now? This one is talking about gross profit margin. Margin is talking about revenue. So that, and this is gross profit. So it means gross profit over revenue multiplied by 100%. Are you getting that? Gross profits divided by revenue multiplied by 100%. When we're talking about PBIT margin, it's talking about profit before interest and tax over revenue multiplied by 100%. So when you're talking about this profit before interest and tax, you will pick profit before tax. You will not add back interest. Pick profits before tax, then add back interest. That is profit before interest. Are we good to go? The next one is net profit margin from the word net profits over revenue multiplied by 100%. Okay. Then ROCE. This one is talking about return on capital employed. Return on capital employed. So you can use two ways. See that you say PBIT, that is profit before interest and tax, over capital employed. Over capital employed. This over capital employed. So what is now the capital employed? Capital employed simply means total assets minus current liability. Total assets minus current liability. Or you can say equity plus long-term debt. Equity plus long-term debt. That is, any debt you see, any payable you see, any liability you see under non-current asset, then you will add it to what? To equity. Are we good to go? Do you understand that method? Capital employed is the same thing as total assets minus current liability. Or it can be equity plus debt. Equity plus debt. Are we good to go? The next one is return on equity. Return on equity is talking about PBIT over equity. PBIT over equity. Return on equity. Then return on assets simply means PBIT over what? Over total assets. That is return on asset. PBIT over total assets. Then growth in revenue. That one is talking about changes a year over, how should I put it? Changes in year over previous year multiplied by 100%. So when we're talking about changes in year now, we're talking about last year minus this year to know the difference, to know the changes. Then over the previous year, for those who are doing case study, just normal our trend analysis. Are we good to go? So these are the ratios you can calculate under what? Under profitability ratios. So I believe we are good with this. Sorry, let me just try to do something with this. Someone has started our settings. Okay. So that is all we need to know under profitability ratio. The next one is what? Is efficiency ratio. Under efficiency ratio, we are talking about 4 things. We are talking about inventory. We are talking about receivables. We are talking about payables. And we are talking about cash. Efficiency. We are talking about 4 things. Efficiency is talking about payables, receivable, inventory, and cash. Now, we can calculate 2 things here. You can calculate period. Or we can calculate the turnover. So when you are calculating the period, we are talking about inventory. It's going to be average inventory over cost of sales, or before cost of sales, over purchase or cost of sales. Purchases is the main formula. But in a case where there's no purchases in that question, you use cost of sales as a substitute. Then multiply by 365 weeks. Inventory period. Yes. Inventory holding period. Anything you see period about, it means they're talking about this aspect. Then when they want to talk about the turnover, they will ask you about turnover. You will see turnover there. Are we good to go now? So we're supposed to use average inventory normally, and we're supposed to use purchases. But in a question where you cannot determine the average inventory, you will use what? You will use the normal closing inventory. Assuming you have 2018 and 2017. And this one is 20. Let's say inventory here is 20 and 30. So in this case now, we'll not be able to get the opening. Is it possible from here? No. Okay. Assuming we are calculating for, if they ask us to calculate for only 2018, we can use the average inventory. But if they ask us to calculate for both 2018 and 2017, we will not be able to determine average inventory for 2017, but we can determine for 2018. You understand now? So in this case now, because we are calculating for both years, we won't be able to use this average inventory, because whatever we do for 2018 must be the same thing we are going to do for 2017, so that we can compare the two together. So in this case now, we will only use the closing period figure, which is 20 and 30. So when you are calculating for 2018, you use 20. When you are calculating for 2017, you use 30. I believe you are getting that gist. Then divided by purchases, of course. There is the same thing to receivables. Receivable is average receivables. Average receivable over credit sales. Credit sales is the main formula. But when there is no credit sales, you will use what? You will use revenue multiplied by 365 days, because we are talking about period. Then the same thing to payables. Payable will be average payable. If you will be able to get the average payable, then over what? Over purchases. If there's no purchases, you use what? You use cost of sales as well. Multiply by 365 days. Then for cash, when you're talking about cash ratio is talking about cash and cash equivalent. Cash and cash equivalent over current liability. Over current liability. Are we good? It's good. So over current liability, And then,
Current liability.
yes, current liability. Then multiply by 365 days. That is how long it's going to take your cash to cover for your current liabilities. And that is all about that. So this aspect we just look at now is our what? Is our efficiency aspect, which is talking about the period. And that is why we are multiplying by 365, 365, 365. But when we are talking about the other one, which is the turnover, it will now be the opposite of the formula you have there. So if you look at that formula there in the material, the turnover will now be credit sales over what? Over receivable. You turn it over. Then this one also will be cost of sales or purchases over inventory. Then this one will be credit sales over receivable. This one for payable, it will now be purchases or cost of sales over payable. You are turning it over. Are we good with that? And because it's turnover. So what you want to do, we are saying now that it's going to be purchase over inventory. We're also saying credit sales over what? Receivables. So we want to know how many times it will take us to get this receivable. Then whatever you get is going to be in times. That is turnover. So the last one before we start looking at the question is liquidity ratio. The liquidity ratio is also talking about just two things. It's talking about current assets. Is it three things? Current assets, quick or acid ratio. So the current asset is talking about current asset over current liability ratio 1. Then quick ratio is talking about current asset minus inventory over current liability ratio 1. Are we getting that gist now? Now, it's very sweet to calculate, to interpret. That's where the main thing is. Now, let's look at it from the aspect of profitability ratio. The higher the profitability ratios, the better. The higher the profitability ratio, the better, because we are talking about profitability ratio. So if you calculate 2018 and you calculate 2017, and 2018 is better, is higher than 2017, it means the company is doing better in 2018 than 2017, because we are talking about profitability ratio. Yeah, so the higher the better in under profitability ratio. The higher the better under profitability ratio. The higher the better under profitability ratio. Are we good to go? Then under efficiency ratio. Under efficiency ratio, the lower in inventory days, the better. The lower in inventory days, the better. Under efficiency ratio, the lower in inventory days, the better. Then the lower in receivable days, the better. Then in payable, the lower in payable days. The higher in payable days, the better. The higher in payable days, the better. The higher in payable days, the better. And lastly, in cash, the higher for the cash, the better as well. Cash ratio. Yeah, the cash. Yes, the higher the cash ratio, the better. Then under liquidity now, which is the last part, the higher in ratio, the better. The higher in current ratio or quick ratio, the better. Under liquidity ratio, the higher, the better. The higher, the better. So let's look at a question. I've already shared that question on the platform. Okay, we are here to talk about the GM ratio, Abi. So for the GN ratio, we have two. We have GN ratio, which is talking about debt over debt plus what? Plus equity. So the debt you are talking about is the long-term debt. Then the debt you are adding also the long-term debt. Then divide it and you are going to prove. Don't worry. So let's take a question to explain that. Okay. That question I sent to that place is what year is that? 2021. May I be? Yes. Question 3. We'll come back to that question 1 later. That question 1 is talking about cash flow. So are we good to go? Another thing you must know is that anytime you are calculating your ratios, make sure you put it in tabular formats. Now the same thing. So can someone help us to read that question? Let me also open it here. Anyone online who wants to help us so that we get the understanding of the question before solving. The Chief Executive Officer, CEO of Agege PSC, has forwarded the draft financial statements of Somolu Limited through an email to you as the company's financial consultant. In the email, the Chief Executive Officer informed you that Agege PSC is planning to acquire Somolu Limited. Is it also a group cash flow? He's talking about acquisition. Yes. Somolu Limited is a private limited company that has recently applied for additional funds, which was rejected from its current bankers on the basis that the company has insufficient assets to offer as a security. So the draft financial statement of Somolu Limited as at December 31st, 2019 are as follows. So carry out a critical analysis that's required now of the financial performance. Anytime you hear about financial performance, they are talking about what? Profitability ratios. Anywhere you hear financial performance is talking about profitability ratios. Okay. Then, position of Somolu Limited together with recommendation. So the position is talking about the ratios you are going to calculate that relates to what? That relates to balance sheet items. And the ratio you are going to calculate that relates to balance sheet items are efficiency, liquidity. Are we good to go? There, our leverage ratio as well. Now, and recommendation. So it means after you have calculated your ratios, make sure you interpret as to whether Agege Limited should consider the investment in Somolu or what or not. And that is what they have done. 14 marks. It's not more than that. So if you want to do it, we can say performance. What they ask us to do, performance what? Performance. Financial performance. So financial performance. Of Somolu Limited. So I will start with profitability ratio. Now, this one we are calculating here is an appendix. What they ask you to do, go is the recommendation. But you cannot give the recommendation without these calculations. So if you like, you can do this calculation first. And then later you now write your report. I believe you have been writing reports in tax, for those who are writing tax. Yes or no?
Yes.
And for those who are writing case study too. You haven't been writing report. And it's coming today now. We will do the report today. But it's what you can do. All you just have to put for that report is to put the dates and the normal address on it. That's all.
That's what they keep saying.
Yes. Okay, don't worry. I'm going to briefly explain two types of reports: the internal memo and the normal report.
You have done that.
You have done that too. Yes. What again do you need?
The one you have done.
Mr. Wiley,
I've done what?
internal memo and external memo. You were saying you need to present external. You have address. If it is internal, it is.
Okay, don't worry. I will explain again.
What should I join? You write because that's like talking like that. You write because we got
We have 20. How many? Which one is what year? 2018 and so 19 and 18. So you can do it this way. So I'll just bring it down. Bring it
Now
down.
you are going to remove that.
Yeah.
So,
No, don't use red pen. You can use
no, I'm just joking.
just use your normal.
Barry,
normal.
yes.
Yes. They even put it in the instruction. Don't use red pens.
I'll use green pen.
Okay, so we want to calculate ratios under profitability ratio. So let's start with the first one. Gross profits margin. Okay, I believe online can hear us. So from the formula will be gross profits over what? Over revenue multiplied by 100%. So you can start the workings here. For 2018 or for 2019, what do we have? What is our gross profit in 2019? Online, I believe you are with me. What's our gross profit in 2019? 2,300 over what's our revenue? 6,400 multiplied by 100%. Then for 20, let me just divide this into 2. Then for 2019, 1,100 over what is our 37 multiplied by 100%. So what do we get for these two? 5.9. This one, 5.9. 35.94. This one,
29.7.
29.73%. Are we good to go now? So that is what they asked us to do. Now, assuming here now, I only put this figure. And I put 29.7. Am I right? Eh? Assuming I put 29.7. Am I correct?
No.
Why?
That was the consistency.
I have to be consistent. If I decide to say, I can round this thing up now, this is 30%. I'm wrong because this one has been in 2 decimal places. So I can't say this one is not 30. So I must be consistent with whatever I'm doing. 29.73. Are we good to go? So that is gross profit margin. What is the next one we say we can do? PBIT margin, Abi. So PBIT margin simply means what? PBIT over what? Over revenue multiplied by 100%. When you put the formula, the examiner will know that you are not copying from anybody.
Yeah, I feel like right. I like.
So it will also help you to know what figure am I bringing in this thing. So from here now, what's our PBIT in that question? It's not there.
Yeah.
How do you get it, sir?
That's profit before tax.
How much is our profit before tax?
That's 940.
940. So if profit before tax is 940, how much is our interest?
Finance cost is
80. So finance cost is 80 over revenue is 6,400 multiplied by 100%. So I will only do one now. I'll be doing only for 2019 now for you to see.
Yeah, that,
15.94.
So for 2018 will be the same. Sorry, sir.
15.94.
15.94%.
Yes.
Okay, I think we still have space here. So let's do the other one. For 2018, come. See after.
200 plus 40.
200 plus 40 over 3,700, I mean,
Yes.
100%. What do we get?
6.49.
6.49%. Are we good to go? The next one we can calculate is what? Net profit margin. Net profit margin. And that one is talking from the words. Net profits over revenue, Abi, multiplied by 100%. So what is our net profit in 2019? 840. Make sure you're also getting where they are picking the figure from. That one can take you 1 hour. Very important. Over revenue is 6,400 multiplied by 100%. This 2018 what's our net profit? 180 over 3,700 multiplied by 100%. What do we get?
13.13.
13.13.
4.86.
4.86%. Are we good to go? We can as well calculate our growth in revenue. Abi, so growth in revenue means changes in year over what? Over previous year. Multiplied by what? 100%. So what's our revenue in 2019?
64.
64 minus 3,700, Abi, all over, what's our previous year? 3,700 multiplied by 100%. We cannot calculate for 2018 because we don't know the previous year revenue. So when you divide this one, what do we get?
That's 72.97.
72.97%. For 2018, we cannot get that. So after that, we can now calculate our what? Our Rosie. Rosie is talking about return on capital employed, which is talking about PBIT over capital what? Employed, multiplied by 100%. Now, listen to this. Anytime you are calculating profitability ratios, if you are to do two ratios there, make sure capital employed is part of it. If you are calculating, if they ask you to calculate just two ratios under profitability ratio, make sure this man is part of the ratio. Are you getting that? Even if they ask you to calculate one, calculate that one. But everything is doing bala 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 bala. You can now leave it. You don't have to arrive at it. Leave it. Take the any 3 or any 2 from here. But if you look at it and you see that I can get this one now. So make sure this one is part of your. Are we good to go? What is our process? All our bits is here. Our PBIT is this over what? What's our capital employed? How do we get 174?
Thank you. Thank you for asking that.
What's our total assets? What's our total assets? 220.
Yes.
You can say plus current debts. I mean non-current debts. What's our non-current asset? Non-current liability there?
What you have there,
This is total asset.
Yes.
What is our current? What's our equity? What's our equity? 13. 440. 440 is our non-current liability. So if you want to go this way, you are good to go.
It's 440, not 460.
440. If you want to go this way, you can go this way. That is equity. If you are not looking at that figure, you won't understand it. Which one is not there?
You are saying if you want to go this way, you can go this way. I'm waiting for you to say the other way.
Okay.
I would like to do this one.
Okay. This one is equity. This is equity. And this is non-current. This is non-current liability. Are we good to go? This is non-current liability. Or you can say total assets minus current liability. What is our total asset? 22, Abi. What's our total current liability? 460. So does it give us the same thing?
Yes.
So either of the two, you are good to go. So you can choose which one you want to go.
And maybe because I wasn't doing
Which one are you using? Which one are you using?
No,
That's what you are doing.
So that if you check the no current liability, please pay.
But I think this first one is more better.
I think it's the other one.
Equity plus, especially when you see long-term debt, you just add long-term debt. So online, I believe you are with us. So you can choose either of the two. You are good to go. Eh? Non-current liability. Have you seen it? So they separated the non-current liability equity. Are we good to go now? Can I clean this one? So online, they are very quiet today. Today is our final day. It's better you talk everything you have now. Then this one, what is this one all about? I mean, for 2018, what is our PBIT? Our PBIT is here 200, I mean, plus 40. Am I right? This one will be multiplied by 100%. So, what is our equity? What is our equity in 2018? 1160. 1160 plus 400 multiplied by 100%. People of God, what do you have for 2019? 58.62%. How about the last one? $240. 15.38%.
The margin.
So which one is doing better? Okay. So let's quickly do the return on equity. Return on equity will be what? PBIT over equity. So our PBIT here is 940 plus 80 over equity. Our equity here is 1,300. 100%. This will be 200 plus 40 over 1160 times 100%. What do we get? What do we get? Return on equity. Ponce. 78.46%. This one. 20.689%. Now, in your exam, and you think that this thing is taking too much time, it's not compulsory that you must calculate all the ratios. Like this question now, did not specify which ratio you should calculate. But in some question, they will list like this. They will list it like this. Now, calculate gross profit, calculate net profit, calculate ROCE, calculate ROE. Do you understand? So, in a question where they did not list what you are going to calculate, Just calculate like 3 or 4. Interpret 3 or 4. Interpret because of time. And always look at mark allotted. If the mark no make sense, don't make those things.
It is not between 20 marks. I know what I do. You know what I do? It's not, you can't do it for it. It's like you don't know where you're going to do it. And you get exactly right. I'll move on. Because the one that you have, one that have 60 months.
So this one is talking about PBT is talking about total assets. Yes, PBT over total assets. So from that question, what's our PBT? We still have 940 plus 80 over what is our total assets? What's our total assets? 22. Multiplied by 100%. This one will be what? 1940 multiplied by 100%. What do you get for the first one? $46.8 what?
36.
46.36. Okay, the second one. 12.37. So that is all we can calculate under profitability ratio. So the next one we calculate is the efficiency ratio. And after efficiency ratio, we do the liquidity, and that's all. Yes, if they ask us to do the question, we look at the question also. We can also do the gearing aspect. By 1:30, we should finish this question. This is only just the question I'm going to say.
Are we doing the cash flow? Yes, ma'am.
Can we do the ratio of cash flow? Okay, can we do the cash flow? And we can look at it together. But we'll not finish it, sure. I can do only the operating aspect.
Okay. You think of the game.
Mama, I have snap. I don't like reading at night. It will weaken you. So it's better you just read up to 10. Go and see. Wake up early around 5. Was reading at the midnight. I hate it. It will scatter that's just it. Okay. For ratios. We have formulas. We have workings. 2019.
I was thinking
2018.
No, nice.
Online, are we together? Can you say something? I want to believe that. All right.
Yes, sir.
Under efficiency ratios, I believe you still know the ratio we can calculate. So let's start with inventory period. So which is going to be what? Average inventory over purchase or cost of sales multiplied by 365 days. So in this question, we won't be able to do that average because we have 2 years and we won't be able to get for the other year. So we just take the closing inventory. What is closing inventory for 2019? Closing inventory for 2019. 13. For do we have purchases in the question? No. So we have cost of sales. How much is the cost of sales?
2019 now.
2019.
6,000.
Yeah, you know that I'm 4-1.
I'm trying to, I don't even know where to stay.
I'm telling you, power and God now. That's why you don't need to now.
Sexual.
Okay, for 2018, what do we have? What is closing for inventory? For 2018, closing inventory. 1, 2. Then our 26 multiplied by 365 days. So what do you have for 2019 and 18?
I write rubbish.
19 and
100%.
18.
I know it's not 100%. For 2018, we have 46.
46. 46.15 days.
Yes, I know. What am I saying to them? I know them.
Okay, how about 2019? 2019.
I think I've gone from that 2019 115.7.
115.71. 0.7.
Yes, yes.
That's 0.70, I mean. Days.
Yeah, I said it. I wrote it. I gave it that. It was 168.50.
168.50. Do you know why I'm putting 0.50? Because we have been using 2 decimal places. So if you now start using 1 decimal places now, you are not consistent. People of God, what year are they doing better? In what year?
The lower the inventory days and so
They are doing better in 2019 because the days to turn the inventory to what? To cash is lower. They will get their money on time than this one. Then the next one is receivable days. Receivable period. That would be average receivable over credit sales or revenue multiplied by 365 days. People of God, what's our receivable in 2019? Our closing receivable in 2019? 460. Over what's our credit sales or revenue? 6,400 multiplied by 365 days. For 2018,
320.
320 over
37.
37. 365 bits. What do we get for both? I think that this topic is just jolly topic. What is it, sir? 26.
Okay.
For
With our Jane.
It's not everybody here that do ratios.
JJ.
It's like they do every year.
It's not a thing, but
almost every year. You know that ratio is very vital for accounting.
yeah, actually, very, very. I think
That's 1.57.
Sir?
That's 1.57.
1.17. 1757. 5 days. Okay, so the next one is payable days. We can as well call it payable pay time. Pay time. So this one is average payable over purchase or cost of sales multiplied by 6365 days. What's our payable? We can't get the average payable, but we can get the closing payable. What's our payable for 2019? 360 over our purchases 4141 over and multiplied by 365 days. For 2018, 380 over 2600 multiplied by 365 days. What do we get for this? 22.
32.05.
32.05 days. This one.
53.35.
53.
53.35.
So we said this one is doing better, Abi. Which one is doing better here too? For receivable. For receivable too.
Is it not that state? No, okay,
So how about payable?
The payable is higher. You are keeping your own to do business.
I will put together. So that is the better for them. Then for cash ratio. What do I say the cash ratio is all about again? Cash and cash equivalent over current liabilities. Abi, people of God. What is our cash and cash equivalent in 2019? Cash and cash equivalent in 2019. So what is our current liability? 460. What do we get? Multiply by 100%. We get 0. How about the second one? Over 380. Multiply by 100%. This one is 0. This one called the second one.
Okay, sorry. 10.53.
10.53. 10.53. So it has summarized everything. So that is all we can calculate under efficiency. I believe my online are with us. So this one is just a jolly topic
But I'll do it again.
And that is why we put it at the end.
I mean, it's not that you're supposed to use to power to power, but that was now in at the beginning.
So after these calculations now, we will read the report together to see how the report is supposed to be. Don't forget the calculation. If you do all this calculation, they can give you like 7 marks.
I cannot.
The interpretation can now be like 7. That's
That's
what.
fair now. If I can give them small English.
Uh,
Out of 20 marks,
Is it 20 marks question?
And
This one is 14.
that's because the same should be catch me now. The other one.
That question 1 is divided into 3.
Add something. You guys want 20.
I will do it.
No, for me, anytime I see ratio, that ratio now by fire by force. The bonus mark for me.
We must careful.
I go and see the donor of the investment. I want here. He said here. They brought
What will tell me?
I
Interest where you buy them.
Now that means.
put it when I reach my park. And that time they said we should have 50. Very well.
You know, it's a bonus mark now. It's something, it's very simple
That time
and you should be able to interpret it. That's just it. So it's something you can just grab your mark and go. And it will not take you much time.
So that's what I'm telling them that if you know it, you not spend much time there.
Yeah, exactly.
You just be careful with your calculator.
So the next one is liquidity.
Or you do it down later. Come and do your calculation.
Don't forget, we are here to do the turnover. So once you do the turnover, you just turn it over. The formula is also there. So it will be cost of sales over receivable. Calculate it. Yes. Ratio, formula, workings, 19. So we can start with current ratio. The current ratio is talking about current assets over current liability, ratio 1. So what's our current assets in the question? People of question. Current assets in the question. 176. Okay.
Okay.
Over
Current.
460. Then the second one, 1560
over 380.
380 ratio 1. So what do we get for first one?
I don't want to press the calculator, said please. 3.8.
3.82 ratio 1. Everything must be ratio 1. Last window in skills.
4.11.
4.11. 4.
Please, 4.11, Joe.
Ratio 1.
I'll give you blow. Don't mind me.
Okay, do you approximate?
No, approximate any.
They are both doing fine. They are doing fine in both years. Because it's up to 1 ratio. It's more than 1 ratio 1. But they are doing better in 2018 than 2019. So what you want to explain, that's why I'm going to explain. Then current, quick and what do we call that? Quick or acid? Quick or
Asset inventory. I don't know how to get this formula.
current asset inventory ratio 1. So what is our, we have all the information already on the what is our inventory in 2019? 1,3. What's our inventory in 2018? 1,2. So what will be the answer, people of God?
Zero point one.
0.9. Okay. The 0.9 ratio. Don't approximate. Just leave it this way.
The 2091 ratio 1.
This one is what?
1
1:1.
ratio 1.
Which one is better?
2019 is doing
2019 is doing
better.
better, abi? So that is all we can calculate here. Then leverage ratio. That one is just, should we just do that one? Let me just do one here. Gearing ratio. So let me just call this one leverage. So under gearing ratio, we have debts over debts plus equity. So let's quickly do this one. This is the last one we are going to do. What's our debt in 2019? What's our debt? Our non-current liability. What are our non-current liability? For something, Abi. 440, Abi. It's also going to be 440. Our equity should be 133. So that is for 20. Then for 2018, what's our 400? 400 is our debts. 400 plus our equity.
116.
1160. So what do we get for this? Multiply by 100%. Multiply by 100%. Multiply by 100%. What do we get for 18 and 19?
For 19, 25.43.
25.43%. This one. 25.64%. Which one is better? Eh? What happened if this thing is up to 50%? Let's assume that you calculate it now, and this thing is up to 50%. That is what we call highly geared. 25.29. Yes, it's highly geared. At least we have done on gear and gear today. So when this one is more than, the debts over these two, when this one is almost 50 and above, it means the company is highly geared. They are financed mostly by debts. But now they are still normal, but they are doing better in 2019 than 2018. Though they are okay, the company is not highly geared, but they are doing better in 2019 because they have lower percentage of gearing ratio than 2018. 18. Are we getting that gist now? To calculate is good, but you must be able to interpret. Assuming you want to do the leverage, interest cover now. Interest cover. Interest cover will be interest over what? Interest over what? Is in that material?
Interest over.
Is it the cost? That interest is the finance cost already. So what are you going to put on that? Look at the last material, the material we are looking. Check the last in that material. So this is where I'm going to stop. So we are going to read that report together now. So let's read the report they have written together for better understanding. So the first thing you must do when you are done with reporting, when you are done with calculation, I want to write the report. Let me snap this one. Is that you now be taking all this ratio one by one. You can calculate that one yourself. It's in the material we shared. The last formula. You must also know the limitation of ratios, people of God. They can chip that one in for you to calculate. They can ask you to calculate it. No, limitation of ratios. One is that is because it's on historical figures. You know, you want to use ratio to make decisions, but you are not depending on historical figures to make future decisions. Does it make sense? You only guide you. Then, if the account is not audited, and you are using ratio to calculate, most of these companies use what? Creative accounting. They will not give you wrong figure, and you will use that wrong figure to determine the fate of that organization. So you can read that material up is there at the last one. I will read it very quickly now. Then when you are talking about the investors ratios too, investors ratios is what you have done this morning under any per share. And look at it, you have any per share, net profit or loss attributable to ordinary shareholders, overweighted average. You have done that. Then price earnings ratio, that is PE ratio, market value of shares over any per share. Then dividend yield, that one is dividend per share over current market price multiplied by 100%. Dividend cover, any per share over dividends per share. Then the interest I'm talking about here is PBIT over interest charged in the year. So PBIT, we have the PBIT in the question already. Profit before interest and tax over interest. Are we good to go? Then the limitation of limitation of interpretation techniques, limitation of ratio analysis. There are so many ratios, and some organizations can decide to, like this capital employed now, they can use different ratio, they can use different method to calculate it. Then limitation to financial statement and financial information, difference in accounting policies will also affect the ratios. We have non-current assets, such as non-current assets, depreciation and estimation. We have other limitation in the use of financial ratio. That is ROCE, which I just explained. Using of historical information, I just mentioned that now. Then creative accounting, window dressing, off balance sheets, finance, profit smoothing, capitalization expenses, and the like. People of God, that is the end of that question. So let me read the reports and let's look at the report, the way they structure their report. After that, I will just explain briefly about the cash flow we are talking about, and then we will say closing prayer.
Sure.
So let's go to that question.
Because I will not let me. They will say that copy. They will want to do something that is not make sense. This guy, like, he goes to the people, say, this is that's what that's what.
Now, see the way they wrote this report to people of God. Before I go to this report, let me use that opportunity to explain the type of reports you will have. Now, you can have internal memo. And you can have normal report. This place is very few, please look up. And in any other paper, this is professional, most of the questions will be based on report. So if you are writing in AA, they will ask you to write report. If you're writing advanced tax, they will ask you to write report. If you're writing case study, that one a report on its own. If you're writing CR, they will ask you to write report. If you're writing SFL, they can also ask you to write report. After calculating, they just advise the management.
I'll say, please, after all this calculation,
And the thing is that if you do all the calculation correctly and you not write that report, you will not get that. Do you understand them? So that's why it's very important. Now, when do we use internal memo? You use internal memo when you are writing within the organization. Maybe they said, like this question now, they are assuming that you work in that organization and they want you to write to the same, like your managing director or your boss, your supervisor is that same organization. You will use internal memo. And to write internal memo, what you just have to write is internal memo at the top. And then you just write internal memo. Are we good to go? So you can write to whosoever they ask you to write to. Maybe they ask you to write it to CFO, chief. Anyone they ask you to write, but I have to write it in full, not in short form like this. Then from what position are you holding as that case? If they say you are assuming you are a junior trainee, you put from junior trainee. Are we good to go? So whatever position you are holding, position you are. Yeah. Okay. Okay. Junior training. So make sure you know that. Then after that, you put what your dates, the dates you are writing the report. Then after that, please. So this thing is very important. So don't joke with it. Too. Then the subject matter. The subject matter. If like this question now, they say you should write, you should analyze the financial performance and position and give recommendation. So at this one as a subject matter, you can write analysis of performance, financial performance, position, position, and recommendation. You underline it. That's the instruction, that's the requirement. You are writing case study, you should know this one by now. You don't want me to bite you.
Position. I wanted to the position of what?
It's in the requirements, and I just go to the requirement and frame that requirement here. So after that, start writing your report. But when you want to write a report under this ratio analysis. We'll be taking all everything one by one. So I will take profitability first.
Well,
Are we good now? So under profitability now, what are the ratios I've talked about? I will take gross profit margin. I will talk about it. I will take net profit. I will talk about it. I will take ROCE. I will talk about it. If the time will not permit me, I can just take these three. But make sure Mr. ROCE is there. Then when you are done with this, you take the next one. So the next one will be what? The next one will be efficiency. Efficiency ratio. You also underline it as another paragraph. This one will form one paragraph. This one will form another paragraph. Then what are the ratios you calculated under efficiency? You calculate inventory period, receivable period, payable, and cash. Do you understand? You also talk about it one by one, what you know, what you can say. You move on. And you are going to tell them in what year are they doing better, which year they are not doing better. And when you are explaining, don't use simple grammar. You have to use accounting grammar terms.
Relatively.
It's not like God is now. God that you know what's on the form.
Then after this, you go to what's the next one? Liquidity. You talk about the two ratios you calculated. You go to the gearing leverage ratios. You calculate the two ratios you calculated. Investor ratios. If they ask you to calculate, you do that one. At the end of the day, you close it. That's the end. This is internal memo. Internal memo. Write your name and your department. That's all. If you are in junior training, which training? Just write it there. That's it. This is internal memo.
It's right. The name of the test. It's not junior training.
No, junior training first. Then under it, you will put your name. Junior training.
And then
Junior training.
Blue side.
After junior training, Abi, then even signature before your name. So let me just go and use it to get money.
The name of that person.
Yes.
Don't write your name.
If it is case study, you not write your name. No.
That's case study now.
They will give you name you are going to use in case study. But that is for internal memo, people of God. If you are using normal report, you are going to have the letterheads. Are you good today? Your own letterhead. So if the report is saying you are you are working in audit firm, you are writing it to third party. Maybe you are working in audit firm and you are writing it to your client. Do you understand? So that report will carry your own.
When the letter, what right is to third party. That's right.
When the report is going
Outside
to third party, that is normal report. That is external report. So you will add your letterhead. But if you don't want to use your letterhead, you can use the normal address. The only thing that will make a difference here is that there won't be this and there won't be this.
So for that place,
You just write chief to the person you want to write it to, junior trainees. But in this case, because a junior staff cannot write to external, it has to come from your boss.
Yeah.
So you put the name of your boss there, put the dates, then everything remains. So it's not matter.
Okay, if there's no letter.
Letter N will be at the top. You can just design something. MO and Co.
Okay.
Chartered accountant.
So, don't need for address, just.
They won't give you letterhead, but it's something you can create within two
Yeah,
seconds. And put your phone number. Okay, so do we need to read the ratio again? So you can just read the report on your own. You can read the report on your own and you're good. Okay, so let me just quickly explain that cash flow.